Hello and welcome to Week 7, Business Entities. By the end of this lesson, you should be able to describe various U.S. business entities, compare and contrast advantages and disadvantages of each type of entity, and explain the tax implications for owners. There are several types of businesses available to U.S. business owners. We'll talk about these 5 different types of entities. First, we'll talk about sole proprietorships. Then we'll also cover partnerships, limited liability companies, S corporations, and finally C corporations. Let's start with sole proprietorships. It is the easiest to form and has the lowest administrative burden. If you decide to open a small business or open a business, you are a sole proprietorship unless you do something else to make yourself a different type of entity. So that's pretty easy. Net income from the business venture is subject not only to income tax, but also to self-employment tax, and that's that payroll tax burden that we see as employees. But if you are self-employed, remember you're paying the employer as well as the employee portion. So there are 2 layers of income tax of taxation for proprietors: income tax and self-employment tax. In addition, it's important to remember that you are taxed on the net business profit, regardless of what you do with it. So if you leave the money in the business bank account, you're still taxed on it. If you use it to reinvest in the business, you're still taxed on that net profit. So there's nothing that can be done to keep an individual business owner from paying tax on the profit each year. You can try to plan that to make the profit less, but once the profit is determined, the sole proprietor must pay income tax and self-employment tax in that year on that income. So sole proprietorships are very easy to form. The downside is there's no liability protection. It's just you, so you are open to personal liability. And also, if you're looking to expand and you'd like outside capital, it's very difficult for sole proprietors to procure that capital. Next, we'll look at partnerships. Partnerships operate similar to sole proprietorships in that the taxation is the same. So net business profit is subject to income tax and usually self-employment tax, although not always, on the net business profit. So again, it doesn't matter if the distributions come out to the partners or not. Once net business profit is set for the year, the partners are going to be responsible for the tax liability associated with that. But partnerships are a little bit more complex. By definition, a partnership has to have at least 2 partners. There is an exception. The single member LLC is disregarded for tax purposes, and we'll talk more about LLCs in a little bit. But partnerships have to be 2 people. And whenever you have 2 people, each state is going to require a little bit more documentation, some sort of partnership agreement or operating agreement. Those requirements vary by state, but certainly it is best business practice to make sure that you hammer out some basics about how decisions are made, how disagreements are resolved, what happens if someone wants to leave the partnership, what happens if someone passes away, how are the ownership and interests transferred, and who has approval on who the new partners will be. So a lot more administrative burden there. In addition, or I should say on the flip side, or offsetting this additional burden, is the fact that partnerships do offer some liability protection. Not a ton, and it depends on whether it's limited or general, but there is a little bit more liability protection compared to the sole proprietorship. Now, LLCs take this one step further. LLCs have the exact same tax reporting requirements as a partnership. In fact, they use the same tax form, the Form 1065. There are also the same basic organizational requirements. Of course, states do have the right to require something slightly different for LLCs than for partnerships, and states vary, and the terminology that is used is different. We say member instead of partner, but more or less that burden is approximately the same, that administrative burden. And the LLC's advantage over the partnership is there's a little bit more liability protection over the general partnership and even limited partnership. Next, we'll talk about S corporations. S corporations also require a separate return. They require even more corporate records. They are a corporation, so in addition to those organizational documents that we talked about with the LLC and the partnership, there are requirements to have regular meetings of owners and minutes of those meetings. There's a stock book that needs to be maintained. So the administrative burden is pretty high. In addition, the S corporation has a little bit better tax attributes, but that also comes with some extra administrative burden. S corporation owners who work in the business are required to pay themselves reasonable compensation. If you're an LLC member or a partnership partner, if you are taking compensation from the partnership, that's all figured on the K-1. But if you're an S corporation owner and you're working in the business, you have to pay yourself payroll. Now, if you don't have other employees in the business, this is an extra cost and an extra administrative burden. In addition, all S corporation owner employees need to be aware of the reasonable compensation issue. What the IRS says about reasonable compensation is that shareholders of an S corporation must pay themselves reasonable compensation. They can't take all of their income as just an allocation of profit from the business. And we'll talk about why in just a second. But the IRS has very studiously avoided giving us good guidelines for what reasonable compensation is. They just say it's what's reasonable for your industry in your area. And so the burden of proof really is on the taxpayer to make sure that that compensation is reasonable. Now, why is W-2 wages versus pass-through income important to the IRS? It all comes down to payroll taxes. So an owner who is an employee pays payroll taxes just like we're all familiar with, just like any other employee. Business pays half, employee has half withheld from their checks. But the S corporation business profit, in contrast to that partnership or LLC, that pass-through net profit is not subject to self-employment taxes. So this can be valuable. It could be up to 15.3% savings, depending on what the compensation is. Sometimes it's just 2.9% savings or maybe 3.8% savings, but there's a potential for savings there. And so the IRS wants to make sure that people who work in a business they also own are paying into the Social Security system. This obviously is a layer of complication that the partnerships, the LLC, and the sole proprietorships don't have. And finally, with respect to liability protection, the S corporation does give even more protection above the LLC in terms of your personal liability with respect to what goes on in the business. Now, the final form of business we'll talk about is the C corporation. Just like the S corporation, partnership, and LLC, the C corporation files a separate return. It has by far the highest administrative burden because it's got those corporate records, the meeting minutes. Corporations are required to pay dividends, and so there's some bookkeeping that goes along with that. Extremely high burden. In contrast to all of the other types of entities we've talked about, the C corporation actually pays tax at the entity level. So that means an entity runs a business, there's a net profit of $100,000 at the end of the year. The C corporation pays taxes on the $100,000, not the owners. Then whatever profit is left over is available to pay to owners. And if that money is paid out, and only when it is paid out, it's considered a dividend and it's taxed to the owners. So that's in contrast again to the other forms of ownership where whatever the profit is, it comes out to the owner and they have no control over the timing of that taxation. But with a C corporation, the owners or the management, more specifically, has control over when they pay dividends to owners and when those owners then would have to pick that dividend up in income. So that sounds like a good idea. You're able to control when owners pay taxes, but unfortunately, generally speaking, two layers of income tax, a layer at the corporate rate and a layer at the individual owner rate, is almost always going to mean higher taxes, higher total tax burden. So why do corporations exist? Well, absolutely for liability protection, for easy transfer of ownership, and to raise capital. So if you think about the most common C corporations, they're going to be your publicly traded securities. So we're familiar with these. They trade on the NASDAQ, on the New York Stock Exchange, on stock exchanges all across the country. So we are very familiar with how easy it is to buy and sell a stock, how easy it is, relatively speaking, to raise capital. And certainly we're familiar with liability protection. Think about all the companies that have been in the news in the last month who have settled lawsuits. Yes, the investors in those corporations can lose the money that they invested. So you buy $10,000 worth of stock, the stock could become worthless and you're out $10,000. But no one has ever been called to pay a judgment against Enron, against the oil companies when they have issues, against the car companies when they have issues. So the C Corporation absolutely offers the highest level of liability protection. The ability to grow the business comes at the expense of double taxation. So it is definitely a form of business that is important to our economy, our national economy. But by and large, small business owners are not going to be C corporations. They're going to be other types of entities, mostly for the lower administrative burden, but also a lot of times for the tax attributes as well. So the last thing we'll talk about with respect to business entities is a new provision called qualified business income. Certain pass-through business owners may be entitled to a deduction of up to 20% of their net business profit. Now, there are a lot of rules around this. There are rules around the type of business being done. So there are certain sets of rules for service businesses and another set of rules for non-service businesses. And then there's a rule for business owners with total income from all sources under a certain amount and over a certain amount. So this is very complex. The law is still evolving around this, but it is an opportunity for business owners to save income taxes in a way that employees cannot. So today we've learned the different types of business entities, the advantages and disadvantages of each type of entity, and a little bit about the tax implications to entities and their owners.